Meanwhile, the Federal Reserve is expected to hold interest rates steady today at a 22-year high in the final rate decision of the year. The Fed expected to take another pause in the rate-raising campaign today, and Chairman Jay Powell will speak and discuss it at 2:30 p.m. Eastern Time. Joining me right now is the Wall Street Journal's chief economics correspondent and the author of $1 Trillion Triage, Nick Timiraos, back with us. And Nick, in your latest article in the Journal, you write this: Powell's press conference could focus heavily on a topic officials have been reluctant to discuss: when rate cuts are coming. Officials don't want to declare victory yet on inflation or cause a market rally that makes it harder to sustain the slower economic growth they believe necessary to conquer inflation. And yet, Nick, we see the markets reacting to the potential cut to come. That's why we got a market that is incredibly with this incredible momentum, right?
Yeah, that's right, Maria. I mean, this will be the first Fed meeting in quite a while where they are putting forward those economic projections, and they're not showing a higher terminal or peak interest rate. The next, rate projection will be for the end of 2024, and those dots will probably be lower than where we are right now, which is a 5 3/8% Fed funds rate. So that's different, and the Fed may not want to declare victory yet. So I think one place I'll be looking will be in their policy statement. Do they sort of retain weekly their tightening bias, their bias that says that if they change rates from here, still more likely to be an increase than a cut, even though you'll have those interest rate projections showing 12 months from now, most of the committee thinks interest rates will be lower. So that'll be maybe a little confusing at 2 p.m. today. But the press conference will be the main event. And, interest rate futures markets, like you said, Maria, are pricing in rate cuts. And so I think the question will be, how strongly or not does Jay Powell push back against those expectations?
And of course, you spoke with the Treasury Secretary Janet Yellen yesterday as part of the Wall Street Journal's conference, the CEO's Council Summit. Here's what she had to say when you asked if she still sees a soft landing. Let's roll it.
To me, a soft landing is the economy continues to grow, the labor market remains strong, and inflation comes down. And I believe that's the path we're on.
Most recessions look like soft landings for a little while. What gives you confidence that this might be more like the episode in the mid-1990s than in the last two downturns, absent the COVID shock, where it looked like we were soft landing and then we had a hard landing?
Well, I agree with you that it is an unusual thing to have happen. And it certainly takes skill on the part of the Fed to calibrate monetary policy properly.
Nick, she also told you she sees no reason inflation should not gradually fall to 2%, no good reason to think last inflation mile especially difficult, and that she doesn't see evidence that inflation is ingrained or wage price spiraling. Anything strike you particularly out of that interview yesterday with the Treasury Secretary?
Well, all of those comments that you mentioned are consistent with, someone who probably doesn't see any reason to raise rates from here. And, you are looking ahead now to when to cut rates. So, Yellen was someone who is saying she's not worried about inflation right now. It will take skill for the Fed to manage a soft landing. The prospects of a no landing where the economy doesn't slow down enough, that's gone down. So the prospects of a soft landing have gotten better, but I think soft landings also require luck. If you go back a year ago and you look at what the big worries were for the year ahead, people thought Europe might freeze to death, cut off from energy from Russia. China, how are they going to manage COVID? Were you going to have a big commodities boom as China came back online? We avoided both of those things. And so, policymakers, the global economy got lucky around a year ago. We had a banking crisis this year that really didn't turn into something terribly serious. And then inflation has just improved quite rapidly over the last 6 months. The core CPI yesterday is a 6-month annualized 2.9%. The 6 months before that, we were at 5.1. So skill and luck, I think, is going to be really important to pull off this improbable soft landing.
Well, I mean, she also said high long-term rates should put stress on the fiscal outlook. Yeah, no kidding. We already see stress in a number of areas. Are you surprised that we're not seeing an even slower impact from 11 rate hikes, Nick?
Yeah, I think that's been a puzzle all along, is where are these long and variable lags of monetary policy? We went through, years of very low interest rates, and then to suddenly go up to 5% in just 15 months. I think it has been a surprise, of course, that the economy has been so resilient. And the question now is, can that resilience continue? Are we past sort of the peak impulse of tightening, and so the economy can manage from here? Or is there another shoe to drop? Maturity cliffs for corporate debt markets, you hear about that a lot. Commercial real estate getting marked down. Maybe that hasn't happened yet, but what happens when it does, as these loans have to get termed out? I think those are the big questions for 2024. Where is the impact of the monetary policy tightening, and can the Fed lower rates if there are other shoes to drop before those shoes drop?
Well, you've got a new bank rate survey finding 59% of U.S. adults feel like the economy is already in a recession. This holds true across income levels. Gen X was the age group most likely to say they do feel the U.S. is in a recession, followed by millennials, Nick. And if you're talking about the Fed cutting interest rates 3 times in the second half of next year, is that in response to a recession? Is that in response to a sharply lower and slower macro story?
Great question. Usually it is, right? Usually the Fed is cutting for scary reasons, because the labor market is cracked, the economy's rolling over. And so the reason why the Fed cuts rates next year, if they indeed cut rates, will matter. Obviously a recession, data that looks like a recession, that would get you rate cuts. I think the tantalizing prospect here for the markets of the Fed cutting rates with the economy doing well, so-called normalization cuts, where they simply say, well, inflation's falling, so we don't need to be above 5% anymore. That's where people get excited, and that's where people today are going to want to hear from the Fed chair, well, what is your threshold for cutting rates just to normalize policy so that real rates or inflation-adjusted rates don't continue to climb as inflation comes down? That is what I will be listening for.
Now, and some people would argue it's abnormal to have rates at 0 for 15 years, which is what all of us watched for that time frame. And Nick, what else are you going to be focused on in terms of that press conference at 2:30 with Jay Powell? What are you looking for him to say today?
I think the big question is, does he push back against the market that has priced in, 4 rate cuts, maybe more? I think the economic projections that the committee releases at 2 p.m. will not show nearly so many rate cuts. But that doesn't mean he has to push back against the prospect. He could say something like, well, the market has a different forecast than we do, and so we'll just have to see who's right. That would be sort of, not an endorsement, but not a pushback. And if the rest of the communication that comes out at 2 p.m. is trying to hold the line against all of that, that would be a way for them to sort of say, look, we don't know that we're done. We're not declaring victory, but we're also not saying that the market's completely crazy here. And so I think that's where my ears will be tuned.
All right, and ours will too then. Thank you so much, Nick. Great to see you, and thanks for the preview. We will be watching and talk soon. Nick Timiraos from the Wall Street Journal. Thank you, sir.